Hello, everyone, and welcome to today's major markets update for Good Friday, April 15th, 2022. I know the financial markets are closed, but this is a Easter special, you could say, where we are going to look at where are all the bulls and what are the indexes telling us. To your right, one of my favorite movies of all times, the Batman and the Joker, so to say. And this is one of my most famous actors in the many times this movie has been made. Why so serious? Let's put a smile on that face, because why is everybody so freaking negative? All right, let's see what we have. I'm going to start off with sentiment. Only 15.8% of all the people interviewed or that took the survey by AAII, that is the Association for Individual Investors, moms and pops, I would say, a little bit more geared towards individual retail investors, are bullish. This is an extreme low reading, not seen last in 1992. This is the lowest number of bulls in 30 years. That should mean we should start to rally pretty soon, because if everybody thinking the same, it means someone is not thinking according to general pattern, I believe it is. And this, of course, has been discussed quite extensively on social media and everywhere else. I just got an email by McClellan about this as well. He's not going too far back in time, but it shows pessimism right now is even worse than at the bottom at the COVID crash. But the indexes are most of them only single digits away from all-time highs. So why so serious, right? Let's put a smile on our faces. Tom goes back here to the 1987, 1992 time frame, because that's just the last time we saw such few bulls. There's, of course, also a lot to question about a survey. Again, a survey is a survey. You always say, you got to put your money where your mouth is. This might just be an opinion about the market, but not having any money in the market. And of course, the way the survey is set up, all those things. But honestly, it is what it is. The number is what it is. The why is not so important. So even Tom McClellan has picked up on it, on why this is such a low reading. Also, remember, as Tom says, this is a condition, not a signal. Okay. Same with a pattern. If you have a wedge pattern developing, it's a condition, not yet a signal. What is the signal? When we break out of the wedge pattern. So how bad is it? Here is all the AAII bull data available since 1987. I've seen some people only plot data since 2008. Why leave the majority of the data out? That's cherry picking. That is trying to deceive folks. It is not accurate. That's not science. You use the entire data set. And as you can see, this is the lowest reading since 1992. And since 1997, for about 5-6 years, people were pretty bearish. Now, I wanted to show as well the longer term trend in both sentiment, which is on a weekly basis and therefore spiky, in black, and the stock market in blue. So then in red, we have the 200-week moving average of sentiment. And here in black, we have the 200-week moving average for the stock market. Okay, we kind of want to get away with the spikiness of the market. So we're going to simply get rid of the data. And what are we left with? Very simple. This is the moving average of sentiment, and this is the moving average of the stock market. First thing first, we see improving sentiment, more and more bulls up until 2007. That makes sense because the market has been increasing all the while, except of course here this dip here in the 2000s, early 2000s, but it's been increasing ever since. Rightfully so, according to the 200-week simple moving average. And then, of course, we had the 2008 into 2009 crash. Remember, this is a longer-term moving average, so it takes time for it to finally catch up. And that is because essentially the market, of course, didn't get back above the 2007 high until 2013 or 14. But what is interesting is, look at the bulls. We get less, the higher the financial market goes, less and less bulls. The number of bulls peaked in 2007. So there seems to be a significant societal shift in sentiment going on. What's going on here? I can't really explain it, so to say, but it is quite obvious. Of course, with a few blips and bumps along the way, the general trend is lower, less and less bulls, the higher the market goes. Entirely contrarian to what we saw here. The market goes higher, you expect more bulls. Take out all the spikes, the long-term trend in sentiment of investors is less bullish, whereas the market goes higher and higher. Somebody's wrong, somebody's right. Very quite interestingly. Let's not go here yet. I've tweeted about it and I've not seen people even try to explain it. The only way I can explain it is as I describe in chapter 5 of my book, Tomorrow Happened Yesterday. It's available on Amazon.com. There is the pitch, is that societal mood is shifting negatively. On chapter 5 of my book, I go into societal mood as described by the tone of news coverage since 1945 into 2010. And there's been some actually scientific work done on this, and the tone of the news coverage based on, I would say, the headline news is negative. It becomes more and more negative and more pronounced, actually starting already in the 1990s, okay? So that is quite interesting. So that kind of matches. We're all a negative bunch, right? I'm a glasses half full folk, but it seems like I'm the only one left on this planet. Okay, so despite the world has improved on every single parameter, less poverty, improved climate, environment, improved welfare, improved income, everything. Oh, there are always negatives to find, but on every single metric, please read the book Enlightenment Now by Steven Pinker, and you'll see the data truly there. Everything has gotten better, but somehow we're getting more and more negative. Quite weird, huh? That's why I don't listen to the news. As Thomas Jefferson, one of our famous founding fathers of this beautiful country, said, he who reads nothing but newspapers knows less than he who reads no newspapers. So take that one to your grave. Anyway, interesting. So we have very few bulls left. However, from a bear perspective, well, bears is starting to get high as well. And here you can see again, the number of bears has started to increase. It reasonably followed the financial market a little bit better, peaking here in 2009, dropping here to 2017. And since then, we're getting increasingly negative as well. No extreme reading in the number of bears just yet. Not there yet. Another way to look at it is, are there more bulls or are there more bears? It's simply the bull-bear spread. And 0 means, of course, equal amount of bulls and bears out there. But right now it's quite low. It's minus 32%. It has happened before. Again, the 1990s peak here could have been the Iraq War, for example, as well, the invasion of Kuwait by Iraqi war. That was, of course, a hands-on true war for the United States. 2003, quite negative, right here at the bottom. We had a decent correction in 2006, and then negativity started to increase here, this cluster here between 2008 and 2010. And a weird peak here in 2013, I can't explain. But, you know, there's always one rotten apple among the bunch. Otherwise, the rest we can reasonably well explain on why this is. I don't know this 1992 either, but the point here is that this is quite serious negativity. The rest, we're not that far away from the all-time highs, and I'll show you that with other indexes. So that means we have, of course, now a extreme low bull reading, and we just had a extreme high breadth reading, the highest since 1989 for the Nasdaq McClellan oscillator. So we're currently dealing with an extreme market environment. If you have extremes, you have no precedent. You can only look at something that is akin to this extreme, but not really the same. So you're actually really comparing apples to apples, in the sense, not apples to apples, but apples to oranges. So there was one reading that was above 130 here in 2011, and one here in 2001, about similar, but not the same. This led to another 10-12% correction, Here we're pretty much also, but at the end of the bear market. Here we were in the midst of a bull market. This was a bull market correction. This was a bear market, but please remember we had already declined 50%. Nothing compared to now. I'll show you indexes where you go like, really? Why so serious? I'll show you the index. You go, what? Why so serious? Anyway, so we are dealing with a current extreme market environment with readings most of us have not seen in their entire lifetime, which is quite interesting. So it's hard to really make soup out of things that are unprecedented. That brings me quickly to the short term. And again, I think we're dealing with a leading diagonal wave, A1, and we get a bounce and then lower. Leading diagonals are tricky in the sense that they can always tag on another ABC. When you think the third wave is completed, it tags on another ABC. Remember the summer of last year where we were in this ending diagonal fifth wave, it kept subdividing higher. And I think we have here a subdividing wave A1 lower as well. And this starts to look more like we should bottom at around 43.60, 43.40 before we move higher. And then here we reached, it's a little hard to see, but let me take this away from you here. Sorry, we've reached exactly the 161.8. We bounced exactly to the 100%. So if this diagonal wants to follow the exact impulse pattern based on Fibonacci extensions and retraces, albeit in an overlapping ABC fashion, then we should bottom here 43.40 to about 43.60 in this target zone, and then we bounce. Okay, so let's have a look here. Things still look like they want to turn south. So that is for now the preferred path. Subdividing leading diagonal. Leading diagonals are tricky, and this also is why the short term is so hard to nail exactly, especially during corrections, because diagonals can always tag on other waves. ABC correction, is that the end of the correction or is this the start of a correction, because the correction gets more complex? It's very problematic the shorter term. This is a good explanation by George Maradus, showing that how often the stock market is positive on a daily to 20-year basis. It's almost a toss of a coin on a daily basis. 56% of the time, the stock market is up on a daily basis. Okay, one day, tomorrow, it's almost 50-50 if it's up or down. So that's already tells you that really short-term trading is pretty much a flip of the coin. 1 year out is 76% of the time the financial markets are higher. 5 years out, 88, 10 years out, 95, every 20 years, 100%. This is data from 1926 to 2021, so almost 100 years of data. All right, this is pretty good news. This is, I'm sure, like a rolling average, so to say, but this tells you that the further out you go, the more certain you are the financial markets go higher, because what's the point of having a financial market that trends lower longer term? It's pointless, right? So again, short term, it's really a flip of a coin on if it goes up or down. So that's why the short term assessment is always more subject to change than the longer term. The longer term is easier. I really would have liked him to do a weekly and a monthly assessment, but I'm pretty sure it's somewhere in between. Weekly is probably close to 56%, monthly maybe 65, I would say, so something like that. Not really for sure, but it shows you the further out we look, the more certain we are about where the market is heading. So that brings us then to the Elliott Wave. Okay, the Elliott Wave, you can find on my website. Just click along, so to say. Go to my website, Elliott Wave Theory. This is the basis of the financial markets. This is the standard pattern we look for. When a market starts rallying in 5 waves, this is the pattern we're going to track until proven otherwise. This is your baseline. The market can completely deviate from it. As long as an impulse wave 2 here does not go below the start of wave 1, and wave 3 is not the shortest wave. Wave 4 can actually still overlap with wave 1 in a diagonal, but those are pretty much the 3 main rules. 2 cannot go below the start of wave 1, 3 cannot be the shortest wave, and 4 cannot overlap. And then we're going to look for this Fibonacci-based pattern to develop, where the third of the third wave tops, the third wave, the fifth wave, fourth wave bottoms, and the fifth wave. The Nasdaq did this exact pattern in the summer of last year. It nailed it completely. I show you those charts many times over. It topped where it had to for wave 3, it bottomed where it had to for wave 4, it topped where it had to for wave 5. It was really picture perfect Fibonacci ping pong. All right, absolutely beautiful. Avi Gilbert calls it the pinball, pinpoint, whatever it is. The market tends to follow this quite well. Third waves can extend. Third wave can be a little shorter. 123.6 is fine as well, as long as it's not the shortest. So there are deviations, right? So this is the skeleton we look for. It's like a human or mammalian skeleton, and then we'll eventually figure out which one it is. Remember, shorter term, I was tracking this as well, but it fell apart because this wave 4 overlapped with this wave 1. And then the only motive wave that is left, or some call it impulse, is a ending diagonal. Low odds that that's the case. I don't prefer it. Okay, so with that in mind, this is the standard pattern we're going to look for. Wave 3 needs to top between 138.2 161.8. Okay, let's look at some odd ducks out there that we don't see too much in the news or on Twitter or ever mentioned by the perma bears because they don't fit their narrative. Okay, so here we have the rally started in March 2020. And in my humble opinion, here we have wave 1, wave 2, 1 of 3, 2 of 3, etc., subdividing. And then we see the NYSE or NYA has pretty much gone sideways since March last year. This has gone sideways for 90% of the time for over a year right now. Not too surprising after a 14-month rally. If we get some similarity in time symmetry, this can go on until June this year. Absolutely possible. But why so serious? Look where we topped and look where the NYA is now. This is the broader index. This is a very good overall general measurement on the health of the stock market. What we also see is that we topped right here at 138.2. And so far, we've bottomed right here at 100%. We can even drop to the 76.4% here in black. Not out of the question. I do start to see, though, 5 waves higher from the lows we had on February 24th. Okay, I can zoom in here. And if we zoom in, it looks really like 5 waves up. 1, 2, 3, 4, 5. Oopsies. Okay, bulls be warned, or bears be warned. That looks like 5 waves higher. And how does that relate to the NASDAQ and all those things? That's fine. This one is looking higher. So we've topped right where we had to for wave 3. So far, we've bottomed right where we had to for wave 4. Right? This is where wave 4 is going to bottom. Now, if we do a 38.2 to 23.6% retrace of this entire wave 3, which is also where a 4th wave should bottom, we've reached the target zone in red also. Nothing out of the ordinary. After a 14-month rally, essentially unabated with a few blips, the smaller 3rd, 4th, and 5th waves along the way, this was an unabated rally for 8,500 all the way to 16,000, almost a 50% rally. So is it weird that we see a sideways consolidation? Not at all. This is sideways. The longer the base, the bigger the rally, and I'm still missing a 5th wave. Loudon, where's the 5th wave? We have not even done the typical standard impulse pattern. Not on this one. Okay, what other indexes do we have available? How about the S&P 400, the mid cap? Not mentioned at all by anybody. Very important because the S&P 500 is of course the large cap, but we also have the mid cap. It's the 400. Now I've not given all the extensions the numbers, but you know what I'm talking about right now. 1, 2, 1, 2, picture perfect. This looks like a leading diagonal, potentially expanding leading diagonal, wave 1. Everything's followed so far Fibonacci, picture perfect. Now to me it looks like wave 3 topped here a little bit shy of the 161.8. Well, if the 3rd wave doesn't get there to 161.8, the B wave often does the trick. 9 out of 10 times when the 3rd wave fails to reach that high, the B wave does the trick. The market wants to reach it anyway. And this entire mess here, I have a hard time counting this as an impulse. Maybe my label is off and this is 3 of 3, this is 4 of 3, somewhere there, and that's still fine if this is all of 3. It's fine, it is what it is, but just look on what we are doing. The mid caps are not that far off from the recent all-time high. 2,900 is where it topped, and we're right now at 2,600. Why so serious, right? Look at the NYA. Why so serious? I don't even know what this is, 2-3% down. It's not necessary to be so bearish when you look at these indexes. So this wave 4 can already have topped. It can easily have done so. It starts to look like an impulse here as well. 1, 2, 3, 4, 5. If we break above this downtrend line, wave 5 is underway. I am still missing a wave 5. We've done nothing but go sideways for over a year. So yes, this has been a frustratingly market, but again, nothing out of the ordinary after a 14 months rally going from 1200 to 2750, more than a doubling. So is it so weird to see some nice sideways consolidation? All things aside that are happening in the world, this is a sideways consolidation and nothing else. A pure technical analysis will see this as a massive bull flag. That doesn't mean we're going to top here. We can easily extend. So far, so good. This also looks like 5 waves up. Let's zoom in real quick and have a look. Okay, 1. Let's just label it. This is 1. Make it a little bit bigger. There. 1 for all to see. 2. This looks like 3 to me. And this looks like 4 to me. Am I that crazy? Maybe. And this is 5. Am I biased? Maybe. I don't know. And this is 5. Not okay. Very possible. There. Don't look at all the blue lines and all that stuff. We're simply looking at this here. Is it following any Fibonacci stuff as well? Let's have a look. There. Look at that. Not too bad. Topped here. Top there at 100%. Did we go to the 200%? It starts to look awfully nicely Fibonacci pinball-y or ping-pongy, whatever you want to call it. This 1, 2, 3, 4, right? 3 should have topped here. 4 should have bottomed here, and 5 should have topped there. Looks awfully close to this, doesn't it? Okay. So now we are in a corrective phase. Let's have a look. That can easily go, should just bottom somewhere here. It's nothing out of the ordinary yet. We go below these lows. Okay, I'll say we are still correcting further. That's fine if we correct further, because we still have, of course, quite some ways to go to the downside to even suggest this is not the case. We can easily go to 24.46 or even here to 22.60, 75.60. Not out of the ordinary. Nothing out of the ordinary whatsoever. How to exactly interpret this price action, it's hard to say. That's fine. Looks corrective. Now we'll have to see if we see the breakout. I'm getting bullish. Let's look at the S&P 500 equal weighted index. So the regular S&P 500 is market cap weighted. So the Apples, the Teslas, and the Googles and all those ones have an outsized impact on that index. So that index is therefore also correcting more, because we know that technology is correcting quite extensively. Again, this looks like a fantastic standard impulse. 1, 2, 3, 4, 5, and then 1, 2, etc. Looks really good. And where did we top? So far, again, we topped right here in the ideal third wave target zone, and we haven't even gone to 5,700, which we easily can do for a fourth wave. Based on the Fibonacci pattern, I'm still missing a fifth wave. Where's the fifth wave? If the equal weighted index is going to do a fifth wave, all the other indexes will do a fifth wave as well. Then we're going to look at a little bit of an indicator. This is the 5-day exponential moving average of the slow stochastic, and it started to get pretty low from where normally good bottoms should develop. Okay, so we're getting closer to a low than to a high, I would say, with, of course, the possibility we are going to repeat something like we did here, where it would take several more days before we bottomed. But again, then the upside reward versus the downside risk is, of course, increasing tremendously. Here are several more days of downside, but if you would stick through it for a month, you'd be doing quite well. So again, missing a fifth wave. Where is it? We have not fulfilled this pattern. I don't see it. Let's move on to the value line geometric index. Okay, same path, same pattern, 1, 2, 3, 4, 5. Definitely a deeper retrace, no overlap yet. We topped here at 123.6, a little bit shallow for this third wave. And we topped here then for the B wave, in my humble opinion, at 138.2. Again, typical third wave target zone was missed a little bit, then the B wave often does the trick. I have a hard time counting this as an impulse. This looks like an A, a B, and now looks like a potential expanding, ending diagonal C wave. We had wave 1 here, wave 2, wave 3, bottomed here in January, I believe it was, 123.6 times the length of 1. A complex wave 4, and now potential in wave 5. Again, this is an interpretation of the short-term price action. If we're going to drop lower, we can go to about 578 and still be in the normal range for this wave 4 in black, and then we still get wave 5. We haven't even reached the 5th wave extension. Unless my wave count here is completely wrong, everything aligns reasonably well, very nicely. So we now have a third wave that is longer than the first wave, so the 5th wave can do whatever it wants. Okay, so if we're going to bottom here, we have tremendous upside potential left. So also this one suggests we need to see another 5th wave. So that is index 1, 2, 3, 4. And now we're going to go to the 5th one, the actual S&P 500. Most of you know by now that I count corrective waves on any time frame as down, okay, red candles, and we count impulse waves as up candles. So here is the monthly chart for the S&P 500. And we had 5 up months in a row since March 2020, then 2 down months, 1, 2, and then 2 months up, 1, 2, because we had a down month, up, 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 3, 4. Then we had a little bit of a down month here. Is that 5 and this is 4? It seems a little odd because of where we are in the fib extensions, how little this retrace was. We need to see a second, 4th wave retracing back to the beginning of this 5th wave here. It doesn't make any sense. So this doesn't make any sense. It seems like we are still correcting in a 4th wave. Also because it is hard to count this as all of wave 3, 4, and 5. So also this one strongly suggests we're still in the 4th wave. However, it's going to develop. Wave 2 was short and shallow, then wave 4 will likely be long and deeper. Okay, so that's good as well. And then we're going to look at the S&P 600 small caps. Now the small caps is the only one who could suggest that we have completed already. That doesn't mean that the other indexes, as I showed you, have completed already. Quite the contrary, as I showed you. None of them has so far fulfilled a standard Fibonacci-based impulse pattern. The only one here is the small caps, the S&P 600. The problem is I have here is that this wave 5 does not look like an impulse. It looks way more as a B wave, just like the other indexes. It tagged the 200% extension, which suggests it can be a 5th wave, because that, as we know by now, is the normal ideal 5th wave target zone. But that's pretty much all we get. The rest does not look too impulsive. Then the price action to the downside doesn't look very impulsive either. This whole time frame from, I would say, February last year until now, all looks best like 3 waves up and 3 waves down as part of a larger sideways consolidation. As they say, the longer the base, the bigger the breakout. So support is right here at about 1250, and below that we can try to even fill the gap here at 1150 easily. There would be simply no overlap. If we bottom here, nothing out of the ordinary for this wave 4. Again, this doesn't look very impulsive. I have a hard time knowing where the 1, 2, 3, 4, 5 waves are. If you have it, please share it with me. I don't see it. Again, this is the only index which might start to suggest that we have topped for this index. The other ones really don't. So we have one index that really suggests we're so far following a standard Fibonacci-based ideal wave pattern. We've potentially already completed a wave 1 of 5, as long as we're going to hold the lows we made here in February. Same for this index, the mid cap, same here as well. We reached 161.8. That's typical third wave behavior. Okay, same for the equal weighted index. Everything so far aligns quite well for a third wave and 4th wave. a fifth wave. All right, moving on then to the quick short term. This is the PMO buy all, sell all. We got a nice sell signal here from the ideal sell zone early April, and now we are already back in the ideal buy zone. Okay, history suggests that we are now getting closer to a bottom than to a top. Yes, not all signals have worked brilliantly, but let's go back in time. Once we're in the ideal buy zone and we start to see a bottoming out of this indicator, or either a rally, you can see the performance of what happened. It doesn't work all the time, but it does suggest downside is going to be limited versus upside. What still worries me though is the number of new lows. It is still way too high. So we'll have to diligently wait for this to drop again. It was really nice and low here late March, really suggesting that we had a bottom in place, but we might still try to find these lower levels for this fourth wave before it's completed. But also here, the NYA, please remember, it starts to look like 5 waves up. 1, 2, 3, 4, 5. And this is still a corrective price pattern overlapping. Can go definitely lower, absolutely. It can go all the way back here to about, what level would that be? About 16,000. Would not be out of the ordinary. That would, of course, drag the other indexes lower as well. There's no buy signals and all those good things, but it starts to look impulsive already to the upside since March. So I think I have covered everything right now. Again, we always want to know exactly what it is. The short term is the most variable. If there's 56% chance that it will be an up day the next day, you understand how variable it can be trying to use Elliott Wave. Right now, most of the markets are sideways. They've been consolidating for a very long time, so it's hard to interpret which is the A, which is the B, etc. So we simply have to let this base fill in. Again, after a 14 months, 50 to 60+% rally, or no, even more, so 100 to 200% rally, doubling, right? We had a doubling for most indexes. It's quite normal to see a long congestion of those gains before the next rally can start, especially given the fact that we have no bulls left whatsoever. Okay, it's a condition, it's not a signal, but at some point we all know that the majority can't be right about the markets. That's not how the markets work. So bottom line, we have extreme levels, which are always hard to interpret because there are barely any precedents, right? If you can say, well, we have 20 occasions where it dropped this low, and out of those 20 occasions, 15 were up and 5 were down, odds favor up. We don't. We have simply something that we've never seen before in case of the NDXMO. And we have a number of bulls so low, not seen since 1992, which is a quite different market environment. 1992, we just experienced the 87 crash, which was quite horrendous, but now we're literally, for some indexes, just a hair length away from all-time highs. So why so serious? So why is bullishness declining since 2007 longer term? I think the general societal mood is souring. For whatever reason, I think folks should stop reading the headlines and look outside. The sun is shining, the butterflies are flying. Go for a walk with your dog, have a nice dinner with your wife, eat some chocolate, hold each other's hands, that type of stuff. If you want to know more about it, please read my book, Tomorrow Happened Yesterday. I explain more about it in chapter 5. The short-term chart suggests that the A1 leading diagonal that I'm tracking is still unfolding. We had already technically enough waves in place for it to be complete, but it seems like the market decided to tag on another smaller subwave, so to say, and we could go to 43.40, 43.60 before we see the larger bounce. And that's the problem with diagonals. They can always tag on another set of waves, just as we saw in the summer of 2021. That was the ending diagonal, but the thing is, diagonals have few hard rules other than that wave 3 cannot be the shortest. And of course, wave 2 can't go below the start of wave 1, but that's obvious. So if wave 3 cannot be the shortest, it can just keep on subdividing whatever it wants to do. So this is why I prefer to not focus too often on the short term. It's too variable. See the tweet by George Marodus on the variability on the daily time frame versus longer out. Big picture, long-term holding, big gains. Okay, even the next 20 years, even if we're going to go through a bear market, I think by 20 years from now, we might be already looking a lot rosier than maybe 5-6 years from now. So keep bigger picture in mind. I've reviewed the NYA or the NYSE, the equal weighted S&P 500, the value metric index, the mid-cap index, and all strongly suggest the larger fourth wave is still unfolding. Why? Because they have so far adhered picture perfectly to ideal Fibonacci-based impulse pattern. You people actually track this index. Many have never even heard of them, but they are, of course, equally important as all the other indexes out there. And this all looks still, to me, like a long base after a very big gain. Only the small caps could potentially already have topped, but I don't like the way the fifth wave has reached the upside target of 200%. Also, the monthly chart of the S&P 500 still suggests another fifth wave is needed. Fourth wave are simple, tricky monsters that we have to navigate. So that also brings me to the fact that then the Elliott Wave kind of falls a little bit apart because there can be so many options. After an ABC, expect another ABC and then another ABC, or is the correction over? So it's very variable, the environment we're in. So please focus out, see the forest through the trees, okay? Now, with no bulls left, and all the indexes I covered today so far pretty much strongly suggest that another wave higher is pending, it is indeed time to see the forest through the trees. Okay, ditch the perma bears that are only focusing on a NASDAQ 100 and compare every single blip with 1929 and 2008. Okay, the doom and gloomers, the naysayers, the hate spewers, and the biased amateurs. All right, biased amateurs are the ones that simply slap labels on an index and get it right. Great, fantastic, but that's not how we go about it, because you cannot know if it's an A wave or a first wave after 5 waves up or down. You just don't know, so you have to remain objective. And that's what I remain. So I remain focused on the charts and what the charts are telling me objectively. And all of those that I've covered so far that are very unknown by the majority of people look like we're going through a fourth wave, and some of which are almost close to all-time highs. So why so serious? Let's put a smile on our faces and see what we're going to get. We know the levels to watch when we break down below these Fibonacci retrace levels, right? We cannot have a fourth wave go lower. For example, here, I don't want to see it go below 76.4%. Well, we're still miles away. If we start to break below those, great. Then I know my assessment was wrong. We might have topped quite orthodoxly, so to say. But I also know if we're going to get the breakout above these downtrend lines, I'm definitely going to look higher. So for now, we got to let this sideways consolidation play out in all these indexes and see if we get the breakouts or breakdowns. We haven't reached even the lower ends of these target zones. So all of it still suggests a fourth wave with a fifth wave pending. So I hope you appreciate this new look on different indexes, so to say, and why we should still expect another fifth wave to come, unless we start breaking down below the key support levels, and we haven't even gotten close on any of these still very important but lesser known indexes. So with that, I hope you appreciate this special update. So let's put a smile on our faces. No need to be so serious. If there's no bull left, then there's only buying to do because everybody has sold. And I think we should still see those higher prices. That is still my preferred point of view. It's been going sideways for a long time in those indexes, and the market takes its sweet time. And it is what it is, but the longer the base, the bigger the breakout. That's kind of the rule we should keep in mind. Take care, trade safe. See you all on Monday. Bye.